In this short video, I'm going to cover two very tax-efficient ways of making charitable contributions directly from a pre-tax retirement account, such as an IRA or a 401k. So I mentioned two different ways. One is while you are alive, and the other is when you pass away. So while you are alive, and this is going to be for folks who are age 70 or over, you can actually make what are called qualified charitable distributions from these pre-tax retirement accounts. And when you pass away, you can set up a not-for-profit entity as a beneficiary of one of these pre-tax accounts. So qualified charitable distributions, or QCDs, they are very straightforward. It essentially requires you working with your financial advisor or the custodian for your retirement account and making a request that they make a contribution directly from your account to the charitable organization. Now that means directly to the organization. You cannot have a check written to you and then you turn around and write a check to the organization. The check needs to be made out directly to them or electronically transferred directly to them. So let's talk about tax advantages. I'm going to go straight to an example, and hopefully this will explain it better. So for this example, we have a married couple who are over age 70 and a half, and they have the following income and itemized deductions. So for income, they've got $50,000 a year from pensions. They've got $45,000 of combined Social Security benefits, and 85% of that is going to be taxable to them. And they're taking $30,000 of distributions from an IRA during the year. For itemized deductions, they don't have a mortgage anymore, so really they're down to just property and sales tax, and in this case, $10,000 of charitable donations if they don't use a qualified charitable distribution. Here's how it looks with two different scenarios. So the column in the middle shows their tax situation if they don't make a qualified charitable distribution. And then the column on the right-hand side shows what it looks like with a qualified charitable distribution. And you're going to see that there's only one thing that changes. So starting off at the top, they have $30,000 of distributions from their IRAs. And in the Without QCD column, you'll see there's no deduction for making a QCD from the IRA. So they have $30,000 of taxable income from the IRA. They've got their $50,000 pension, and as I mentioned, 85% of their Social Security benefits are taxable, so that comes out to $38,000 for the year. Their adjusted gross income is $118,000. They do have the tax and the charitable donation itemized deductions, but those don't add up to anything close to what their standard deduction is, which is $27,400 based on their filing status and their age. So their taxable income is going to be $90,600. Estimated tax on that is roughly $11,500, and they are in the 22% tax bracket. So going over to the right-hand side, same information, except that you'll see that we've deducted $10,000 of their IRA distributions, because instead of taking the full $30,000 as a distribution to their bank account, they chose to make $10,000 of those distributions qualified charitable distributions, which means they sent checks for $10,000 directly from their IRA to the not-for-profit entities. So the taxable amount to them from their distributions from the IRA is only $20,000. They still have the pension of $50,000. They still have taxable Social Security of $38,000. But you'll see their adjusted gross income is $10,000 lower. Now down in the itemized deduction section, they still get to claim their taxes, real estate sales tax, but they don't get to take a deduction for the charitable gift because they got that benefit up above as a QCD. But it doesn't matter. They're going to take the standard deduction either way. So bottom line, just by changing the way that they made their donation, they have $10,000 less of taxable income for the year. And as I mentioned, they're in the 22% tax bracket this year. So that $10,000 reduction in income results in a $2,200 reduction in tax. That is a hard dollar tax savings to them by doing essentially the same thing, making $10,000 of donations, but by doing it a different way with the QCD. So when can you start? Well, you might have noticed in that previous example that I said that this couple is over the age of 70 and a half. Now, both spouses don't have to be over that age, but the spouse with the IRA that the QCDs are coming out of has to be at least age 70 and a half. Now, it's not the year that you turn 70 and a half, it is actually the day that you turn 70 and a half. So if you're in a year where you're turning that age and you want to use QCDs, then you need to stop making donations any other way. Wait till you turn 70 and a half, then you can start making qualified charitable distributions from your IRA. Annual limits. Well, there is a annual limit of $100,000, and now this is per person. So again, if both spouses are over the age of 70 and a half, if both of them have IRAs or 401ks that are pre-tax and they're making QCDs, they could give up to $100,000 each, or $200,000 as a couple that way. Now, the limit is not based on your required minimum distributions. So if you are age 72 or older, then you are aware that you have required minimum distributions from your account every year. Now, these QCDs do count against that required distribution. So if you have a required minimum distribution of $15,000 this year from your IRAs, and you make $10,000 in qualified charitable distributions, that counts towards the 15, and you only have to take 5 more personally and pay tax on that income. However, if you have $15,000 of required minimum distributions this year and you want to give $20,000 to charity, you could do that. You could still make $20,000 of qualified charitable distributions. It would cover the entire $15,000 of your required minimum distribution, but it doesn't stop there. You can actually give, again, up to $100,000 in a year. So reporting your QCDs on your tax return, that may seem like an odd bullet point to have, but this is probably one of the biggest mistakes that people make. When you make QCDs from your IRA or your 401k, you need to keep track of those, and you need to notify your tax return preparer that you made those distributions. And the reason is, when the custodian of that account issues you a 1099 at the end of the year showing all of your distributions from the account, they're not going to say if any of those distributions were for qualified charitable distributions. They're just going to say you took a certain amount out of your IRA. And so if you just enter in that information into your tax software, or your tax preparer does, it's going to show the entire amount coming out of your IRA or your 401k as taxable. So the tax preparer needs to know that they need to offset part of that total amount with the QCDs, which will effectively reduce the amount that is taxable. It's important to make that distinction. Okay, let's talk about how to make a donation from these accounts when you pass away. So essentially, the way this works is anytime you have a pre-tax retirement account, IRA, 401k, 403b, anything like that, you are going to have the opportunity to determine who the beneficiaries of that account are when you pass away. And you're going to document that with the account custodian. So the opportunity here is to name a nonprofit entity as a beneficiary of one of these accounts when you pass away, rather than giving it all to a spouse, all to kids. You can name this not-for-profit beneficiary as either a percentage allocation of the payout when you pass away, or you could do a special beneficiary designation, and it might look something like this. I want to give the first $100,000 of my account to my local church or organization of my choice. Then I want everything else after that to be allocated to my family, and then you give the percentages of how that goes. So that would be a way to actually make a specific beneficiary designation to a not-for-profit entity with one of these accounts. So what is the tax advantage of doing this? Well, again, I've got an example to show this. So here we have an example of an individual who passed away. Their estate value was $600,000, and it consisted of an IRA that was worth $100,000. They had $50,000 cash in the bank, $50,000 in a non-IRA investment account, and their home and other assets were worth $400,000. So you notice at the top, the pre-tax retirement account, I've noted that that is not subject to the probate process. And what that means is it doesn't matter what this individual's will says about their assets. For that account is distributed based on what the beneficiary designation document for that account says. Now, the other assets are actually subject to probate. So this individual's will dictate where those assets go when they pass away. So they wanted to give $100,000 to charity when they pass away. They want the other $500,000 to go to their kids in total assets, and their kids are in the 22% tax bracket for this example. Here's what this looks like. Option 1 is the middle column, and that is that they just put into their will, I want $100,000 to go to my favorite charity, and everything else goes to the kids. And then option 2 on the right, instead of putting anything in the will that says give something to the charity, they just go and they make the charity the beneficiary of their IRA when they pass away. So here's how the taxes work on this. In the option 1 column, where they make the donation through the will, the beginning value of all of their assets that are subject to probate, like I mentioned, everything but the IRA, is $500,000. And they say, take $100,000 of that, give it to the charity. That means that the remaining $400,000 is left to the kids. And there are no taxes paid by the kids at this point. This is under the assumption that the current law says there's a step up in basis of those assets at the death of the owner, which means that any prior gains in those accounts will essentially be wiped out for tax purposes, and the kids won't have to pay any tax on it. Now, the non-probate asset, the IRA, in that middle column, you'll see goes to the kids. $100,000 go to the kids, but that is an entirely taxable account for those kids, just like it was for the owner of the account. So those kids are going to have to take out that money, and due to the Secure Act, they have to take a full distribution of the IRA within 10 years. They could do it all right away. They could wait until the 10th year. They could spread it out. But by the end of 10 years, they have to take a full distribution and pay tax on the income. So again, with kids in the 22% tax bracket, that IRA is going to end up costing them $22,000 in tax. So they get $78,000 of the $100,000 after tax. So down at the bottom in that middle column, you see the estate started out at $600,000. A donation to charity of $100,000 came out. Kids paid $22,000 in tax on the IRA distributions. So really, the net balance to the children of the estate is $478,000. Not bad, but could have done it just slightly different. That's option 2 on the right. You notice at the top, there is no donation to charity out of the probate assets. Instead, in the middle section, the $100,000 balance of the IRA was all donated to charity. None of it went to the kids. Kids got everything else. Well, charities don't pay tax, so there's no tax paid by the charity. Kids didn't inherit it. They don't pay any tax on the income. So down at the bottom, you'll see that we had a beginning value of $600,000 for the estate. $100,000 went to charity in the form of the IRA. And the kids paid no income tax because they didn't inherit anything taxable. So the net remainder to the children is $500,000. So just by giving the IRA to the charity rather than money out of the rest of the estate, this person just saved their kids $22,000 in tax. So what steps do you need to take in order to implement this? Well, one, check your will, because your will may be saying that you're giving something to charity from your probate assets. And if that's the case and you want to switch it to what I've shown you here, you need to go back to your attorney and have them amend, rewrite, codify your will to take that language out of there so that none of the probate assets are going to go to the charity. Then you need to go and work with your 401k provider, your IRA manager, and have them provide you with a beneficiary designation form so that you can revise that. And that's where you want to put in special language that says either a percent of what you have in that account goes to a charity, or possibly a certain dollar amount goes to the charity, and then the rest goes to family, or it could be the whole balance if that's what you want to do. So the key takeaways: 2 really tax-efficient ways of making charitable contributions. One during lifetime if you're over age 70 and a half, and the other you can set up now no matter what age you're at, but it happens when you pass away. Are qualified charitable distributions and making charitable bequests by changing the beneficiary designations on your retirement accounts. If you have some specific questions about your account you'd like to run by me, please feel free to contact me. You can see my email and my phone number there on the screen. So I look forward to talking to you.